Hi, people. Good morning, good evening, good afternoon, depending on where you're watching from. This is Econoscope, your front row seat to the global economy, where we break down global headlines and explain what they mean for Nigeria and Africa's economy in real time. Dangote Refinery Initial Public Offering (IPO). What investors need to know about Nigeria's most anticipated capital markets deal. If this is your first time joining us, welcome. On this platform, we'll break down the most important developments shaping international finance, geopolitics, energy markets, oil and gas economics, and global capital markets. You can subscribe to our YouTube channel using Econoscope_1 to stay up to date with the latest development from around the world. Today, we are discussing one of the most anticipated capital market transactions in Nigerian history, the proposed Dangote Refinery Initial Public Offering (IPO). There has been significant interest, speculation, and discussion surrounding the transaction. Many investors are eager to understand what is happening, or what the reported private placement means, and what they should expect when the refinery eventually comes to market. Let's take a deep dive. The IPO everyone is waiting for. At this point, it appears increasingly clear that an IPO is on the horizon. Based on reports circulating in the market, the offering is expected to take place around September 2026, though some reports suggest it could occur towards the end of September or even early October. Whenever it eventually launches, the expectation is that the shares will be made available to Nigerian investors and potentially other qualifying investors who wish to participate. Naturally, investor interest has been intense. As is typically the case with an IPO, the company will announce an offer price, investors will subscribe to the shares, and allocations will subsequently be made. However, one important detail emerging from market discussions is that the transaction is expected to be structured as an offer for subscription rather than an offer for sale, and that distinction is very critical. So, offer for subscription versus offer for sale. An offer for subscription means that new shares are being issued and sold to investors. The funds raised from the transaction flow directly into the company itself. In this case, the proceeds will go into Dangote Refinery and its future expansion plans. The money will not be paid directly to the Dangote Group, to Aliko Dangote personally, or to existing shareholders seeking liquidity. This is an important point, as it suggests that the capital raise is designed primarily to support future growth initiatives rather than provide an exit opportunity for existing owners. From what has been publicly discussed, the refinery's current operations do not necessarily require additional funding for day-to-day activities. Rather, the capital appears intended to support expansion. Investors will recall that management has repeatedly indicated plans to expand refining operations beyond Nigeria and potentially develop refining assets elsewhere in Africa. There have also been statements suggesting that existing demand across West Africa already exceeds current supply capacity. In addition, there remains substantial unmet demand across other regions of Africa. Consequently, the capital raised through the IPO could potentially be deployed toward capacity expansion or regional growth initiatives and broader international ambitions. By contrast, an offer for sale would involve existing shareholders selling their own shares to investors. Under that structure, the proceeds would go directly to the selling shareholders rather than the company itself. Based on current market understanding, that does not appear to be the intended structure for this transaction. And because this would represent the first time the company is offering shares to the investing public, it would qualify as an initial public offering (IPO). So before the anticipated IPO, attention has increasingly shifted toward report of an ongoing private placement. A number of documents and materials have circulated online, and while many appear to have originated from leaks rather than official public disclosures, they have generated significant interest among investors. So, what exactly is a private placement? Private placement is a capital raising exercise in which shares are offered to a selected group of investors rather than to the general public. These investors may include institutional investors, high net worth individuals (HNIs), strategic investors, family offices, private equity firms, and friends and family networks. Unlike an IPO, participation is not open to everyone, and access is restricted to invited investors. That is why it is called a private placement. Why do they conduct a private placement? So there are several reasons why companies conduct private placement before a public offering. One reason is to test investor appetite. For example, if a company intends to raise $10 billion, it may first seek commitment for a portion of that amount through private placement. This allows management to access demand, validate valuation assumptions, and secure capital ahead of the public transactions. So, another advantage is speed. So, the company gains access to capital earlier and can begin deploying funds while preparing for the larger public offering. In effect, a private placement provides an early funding pipeline and reduces execution risk associated with the eventual IPO. It also signals market confidence if sophisticated investors are willing to commit capital before the broader investing public is invited to participate. So, what do we understand about it, about the current placement? So, based on information circulating within investment circles, Dangote Refinery is reportedly seeking to issue approximately 3 billion shares through the private placement. The reported price is approximately $0.35, which is 35 cents per share. So, according to the information available, minimum subscription size is reportedly 1 million shares. At that level, an investor will require approximately $350,000 to participate. So this immediately tells us something important. This is not a retail investor transaction. This is a transaction targeted primarily at large investors. It's for the big boys. So additional subscriptions are reportedly structured in higher increments, making the transaction even more institutional in nature. So, for many retail investors, participation will likely only be possible through pooled investment vehicles, funds, syndicates, or other collective investment structures. According to reports, the refinery is seeking to raise approximately $1 billion through the placement. Interestingly, market demand is reportedly already approaching $2 billion. So if accurate, that would suggest oversubscription and strong investor appetite for exposure to the refinery. The valuation question. Perhaps the most fascinating aspect of the transaction is the valuation. Based on materials circulating in the market, Dangote Refinery is reportedly being valued at approximately $39 0.1 US dollars. I mean, approximately 39.1 billion dollars. Naturally, the immediate question becomes, is that valuation expensive or is it attractive? So the honest answer is that valuation cannot be assessed in isolation. So to properly evaluate a refinery, investors need visibility into projected revenues, cash flows, profitability, operating margins, utilization rates, debt obligations, and future expansion assumptions. At present, much of that information remains unavailable publicly. Therefore, definitive conclusions remain difficult. Nevertheless, when benchmarked against major refining assets globally, valuation in this range does not necessarily appear plausible, particularly given the scale of the project, its strategic importance, and management expansion ambition. A 650,000 barrels per day refinery is a globally significant industrial asset. Moreover, investors are not simply evaluating current capacity. They are also present in future growth potential, regional dominance, and the possibility of expansion beyond existing operations. At a valuation of approximately $9.1 billion, the refinery would immediately become Nigeria's most valuable listed company and one of Africa's most significant corporate entities. This is where we'll stop for part 1. In part 2 of this series, we would cover lockup provisions, why private placement investors face restrictions, the relationship between private placement pricing and IPO pricing, public offer dynamics, retail investor implications, risks and opportunities, final investor takeaways, and market outlook. So this is where we'll stop. It's been Econoscope. Thank you for listening. In part 2 of this video, we will, expose you to those valuable information that I just mentioned. For more insightful updates, information, insights of this nature, follow Econoscope. Follow our page on YouTube, Econoscope_1, and watch as many times as possible. And tell a friend to tell a friend that, Econoscope_1 is providing valuable insight. See you in the next video.